Welcome back to Project Pulse. In the previous lesson, we sized our final term loan amount using the discounted target debt service approach and the max leverage constraint. And in this lesson, we will finalize the debt structure by building the term loan account and then calculating principal repayments and interest expense for each period. If you're new to this Deal Lab series, I recommend starting with part 1, where you can download the Modeler start file for free and build the model alongside me. Link is in the video description below. Now let's jump back to the checkpoint file from our previous modeling lesson. And the first thing we will do is select a different case, because right now we are in a fully merchant case. And let's select case 8 for this lesson, which is going to be a mix of contracted and merchant revenues, so we can see better how the debt sizing shakes out under such a structure. So let's hit the master macro here, and you can see that our final term loan size that we have determined in the previous lesson is jumping up to 76.8 million. And what we're going to tackle in this lesson is row 550 up to row 573. And we will skip the upfront fee for now and instead start by setting up our term loan account. Let's just set up our balance brought forward and carried forward for now. And that is going to equal to, or the balance brought forward is going to equal to our previous period balance carried forward. And this is going to be the sum of our balance brought forward, drawdowns, principal repayments, and then we will also implement a cash sweep in a later lesson. But for this lesson, we will leave that blank, take the sum of all of these. Let's drag this over, Control R. And before we can model a drawdown or link it into our account, we first have to calculate our drawdown further down here in a separate section in row 566 onwards. And we will have a distinction here within the modeler, and that will depend on whether our debt sizing is turned on or off. And in our live case 8, we are in a debt sizing case. And the debt sizing case switch comes from our inputs time independent sheet. So let's flip over there really quick. And what you will see is that our debt sizing in row 254 for case 8 is turned on. And then for the equity based case, as well as the sensitivity cases, for debt and equity, our debt sizing will always be turned off. So this is an important distinction that we will have to consider here. And for our drawdown in the live case, in case it's a debt sizing case, which turns this switch here on. If it's not a debt sizing case, then we will have our term loan drawdown in accordance with our frozen debt structure. But let's start by modeling our live case in a debt sizing case, and that is going to equal to our total final term loan size from the previous lesson that we calculated in H548. Hit F4 once, and we will multiply this with our financial close flag. So select our financial close flag up here, hit F4 2 times, hit enter. And as you might recall from our case study materials, this is not a construction financing. Instead, we assume that our sponsor is acquiring the asset one day before COD, which means financial close for both debt and equity is going to be on the 31st of December 2025. So we do not have any construction drawdowns here, but instead we have one bullet drawdown at financial close. All right, and then let's continue by modeling our applied drawdown. And that is going to equal to our calculated live case in row 567 times our flag in column G. So if it's a debt sizing case, then we want this calculated in live case drawdown to be active. Hit F4 once, and then plus. And if this is not active, we want our drawdown from our frozen structure. So let's multiply this with our flag in column G as well. Hit F4 once, enter, and let's drag this over, Control R. So that means we have our applied drawdown, at least for our debt sizing case for now. which allows us to link our drawdown into our term loan account. So that is going to be a simple linkage, and that is going to equal to our applied drawdown row 569. Let's drag this over, Control R. Now the only thing that we have in the term loan account is our drawdown, which means we will have our term loan balance sitting in the account indefinitely. And what's missing is our principal repayments. But before we can determine our principal repayments, we will have to calculate our interest expense first. Because first, we will use our CFETs to pay our interest expense, and whatever is left over after paying our interest expense will go toward principal repayment. And we will distinguish here between an interest payment excluding any base rate sensitivity and including base rate sensitivity. So let's first start by doing it without any sensitivity. And the interest payment is always due on the balance brought forward in our current period. So let's select K553, hit F4 2 times to only anchor it to our row. And why is it the balance brought forward? That's the interest base. That is because the drawdown here, for instance, occurs at the end of the period. So on the 31st of December 2025. So the first interest payments due will be in 2026 based on the balance at the beginning of the year. And we'll assume that the repayments are going to be at the end of each year. And this is a yearly model, so our case study assumes that debt repayments will always occur at the end of the period, which might be a slight simplification of the case study in comparison to real-world projects. So once we picked up the balance brought forward, we will scroll up and search for our all-in interest rate. And here we will pick up the all-in interest rate for sizing purposes only, which excludes our base rate sensitivity. So let's multiply it with our, we lost the balance brought forward here. So let's pick this up again. Balance brought forward, hit F4 2 times, and then we will multiply this with our all-in interest rate in 535. Hit F4 2 times again. Then lastly, let's multiply this also with our term loan tenor flag in 517. Hit F4 2 times, enter. Now let's drag this over, Control R. And now let's do the same exercise for our interest, including base rate sensitivity. So we again pick up our balance brought forward, F4 2 times. And now we multiply with our all-in interest rate, which includes our base rate sensitivity. Hit F4 2 times. And that's multiplied with our flag again. F4 2 times. Enter. Drag this over, Control R. Actually, we messed up our formatting, so hit Control Z. Take this one, Control C. Mark all these cells and hit Alt H VS F to paste special formulas only. And now we can keep our formatting. Okay, now that we know our actual interest expense, we can now move on to our principal repayment. And very similar to the drawdowns, we will model our principal payments down here and distinguish again between a debt sizing and a frozen debt structure case. And let's start with our live case in 562. And that is going to be equal to, now let's just conceptually think about this. In each period, we will have certain CFETs. And our CFETs are at the top of our senior debt section. And whatever we have in CFETs will be available to repay our interest and principal. And with these CFETs, we have determined a target debt service amount in accordance with our target DSCRs of 1.3 for contracted cash flows and 2.0 for merchant cash flows. So what we will do is we will take our target debt service, excluding any LC interest, of say 8 million in the first period, subtract our interest expense, and whatever is left over after subtracting our interest expense will be used to pay our principal. And to do this, we will start by typing minus min, a minimum function, because we never want to repay more than our actual balance brought forward. And then we also need a max function, so minus min max, open parentheses, and we will start by taking the difference that we just discussed. So we take in row 524 our total target debt service, excluding any LC interest. So pick up K524, and then we subtract our interest expense. And here in the live case, which is also the debt sizing case, we will subtract 573, including any base rate sensitivity, just in case we might consider sizing on a interest rate flex assumption. So close parentheses here. And then we never want this value here to turn negative. So if for whatever reason our total target debt service would be lower than our interest expense, we want to make sure that we only get a principal repayment that doesn't flip any signs accidentally. So that's why we have to make sure that this is the maximum of the difference between this and 0. We don't want this to turn negative. Close parentheses. And then comma for our min function. We also never want to repay more debt than we have to in our balance brought forward. So refer to row 553, close parentheses, hit enter. Now let's drag this over, Control R. And our principal repayment is modeled negative because we will plug it into row 555 so that it actually reduces our term loan balance over time. And for our applied principal in 564, we should be actually able to just pick up the formula that we have done for our drawdown. So copy this, paste it here. Let's see if that's picked up properly. The only thing we have to adjust are our applied flags. Hit enter, drag this over, Control R. So right now we are still in the debt sizing case, which means our applied principal is picking up the calculated live case. And we will also in just a minute implement our hard-coded schedule from our inputs time dependent sheet. But for now, what we can do is link in our principal repayment up here. And now this is going to be equal to minus the maximum of either 0 or comma the minimum of, let's flip the sign again for this one, minus 564. Since we start the formula with a minus, we want to make sure that we include a minus here to actually ensure that our principal repayment is showing up negative. And comma, we also want to make sure here that the balance brought forward is not turning negative. So that's why we have a mix of 0 and the minimum of those two. So if for whatever reason our applied principal were to be larger than our balance brought forward, we ensure that we are not paying down more than we have to. Close parentheses 2 times, and let's drag this formula over, Control R. And now this is actually really interesting, so hit Control Z for just a moment. And what you will notice here is that our principal repayments before we drag the formula over are 47 million, and our interest expense are 69.4 million. And what we did with our NPV approach here is back solving the total term loan amount that our project can take on at exactly that determined target debt service in each specific period. And once we drag over our principal repayment, what is going to happen is our interest payment is reduced and our principal repayment matches exactly our drawdowns. Hit Control R, and you can see that in our check, hit F2, our drawdowns equal our principal repayment. And then let's scroll up. The only error we get right here is our total target debt service on a calculated basis in the live model is now larger than our total paced value. And now this is the effect of, let's scroll up, our levered taxes in the live case, which are now reduced due to senior debt interest payments. And this is the circularity we were discussing in a previous lesson. So now that we have modeled our senior debt interest, what is going to happen is that our taxable income is reduced by the total senior debt interest expense in each period, which essentially lifts up CFETs, and we can actually see the lift up on a target debt service basis, where we now have 123.5 million versus previously only 116.5 million target debt service. So there's a difference of 7 million, and we can break that circularity by simply hitting our debt sizing macro, which now leads to a total target debt service of 124 million after multiple iterations of this problem have been solved. And our total term loan amount is now 80.8 million instead of just 76 million. And you can see that our principal repayments perfectly match our drawdowns, and that is because of the NPV approach that we have implemented in the previous lesson. Okay, and that means we can now implement row 559, where we will determine whether our term loan has been fully repaid and in which period. And that is going to equal to an if statement. And we want multiple conditions to be fulfilled. So that's an AND statement, if AND. And we pick up the total of our drawdowns in column J. Hit F4. And if this is different from 0, which means we have a term loan in place. If it's 0, then we don't want to determine when the term loan is fully repaid because we will never have a drawdown. And the second condition is that the sum of the previous period, hit colon. So we will only anchor the first reference here so that we start taking the sum in column J. And then we will drag over the second reference as we go to the right. And if the sum of all of these equals 0, then we will want our flag to turn on. And our last condition is that round. And we will round our balance carried forward in row 557 by a number of digits, let's say 5, just because Excel might round to a very small number. So we want to make sure that we here round to a maximum of 5 digits, close parentheses. And if this equals 0, then we want a 1, otherwise a 0, close parentheses, hit enter. And we are missing a parenthesis here, and I believe that is after our round function because we haven't completed our AND conditions. Hit enter. Let's drag this over, Control R. And you can see that here in year 2040, our flag is showing up. And let's quickly think through what we just did here. So first we check whether our drawdowns are different from 0. That's the case. So we do have a drawdown. The second condition is that we only want one flag to turn on here, which is why we took the sum of all the previous periods. And if there's no flag active yet, then that condition is fulfilled as well. And the third condition is that this balance carried forward should be near or equal to 0. And that's the case in year 2040, which is why we get a flag. And because of the second condition in our AND statement, we do have a flag here in 2040, which is the reason why we do not get a second flag in the year thereafter. And let's just see how many digits these are. And you can see this is a really tiny number, and that is due to rounding differences when we run our macro. And that calculates us automatically with an XLOOKUP function our term loan repaid date, which is the 31st of December 2040. And this can then later on feed into our scenario output sheet, so that you can clearly see when our final repayment is under which scenario. All right, and now let's actually talk about our frozen debt structures. So what happens if our debt sizing case is not turned on and we assume a frozen debt structure? Let's hop over to our inputs time dependent sheet. And what you will notice here is that in row 141, we take the live case principal repayment, and this is a named range. So here we have a named range of debt principal copy, which using our macro is offset by the live case selected, in our case, case 8. So when case 8 is selected and our debt sizing case is on, then we will copy and paste the hard codes for this repayment structure. And now there are two ways of enabling a frozen debt structure in a different case. So the first way would be that we simply just take this row here, copy it, and only paste the values in, say, case 9, hit Alt-H-V-S-V to only paste the values. But that's rather inconvenient, but would be possible if the debt sizing is turned off in case 9. But for now, let's hit Ctrl-R and make sure there are only zeros for case 9. And what we can do instead is select case 9, where our debt sizing is turned off, as you can see here in row 254. And now if you move over to the operations sheet, you will see that our principal repayment is not picked up because our debt sizing is off. And if our debt sizing is off, we would pick up row 563, which for now is still empty. And if you move back to our inputs time dependent sheet, there will be nothing to be picked up. So just from a financial modeling standpoint, what we will do before we run any sensitivities, what I strongly encourage you to do is first we turn on our debt sizing case and then assume whatever has been assumed in the case that is the basis for this sensitivity. Or if it's the equity base case, we first want to assume what the lender is assuming, size the debt, and once the debt has been sized, we can turn the switch off and use our frozen debt structure instead. And right here, what we do is assume a merchant energy arbitrage haircut of 20%. And we get a warning here. That warning is that we assume that this is a sensitivity. So our model is telling us, be careful with running a debt sizing on a sensitivity case. So here we first select a debt base case. So our model is even warning us whether this is a debt sizing case or sensitivity case. So we really want to make sure that all our assumptions align with case 8 here. And the only difference is the haircut. So what we can do is hit our macro now. But before we do this, let's check out row 9. This is still empty. Now let's hit our macro. And what our macro does, it automatically copy and pastes the hard-coded line in row 9. And you can see that both rows have the same values, which means that now we can flip over to the inputs time independent sheet, select our equity base case or any sensitivity case, and then make sure that there is no haircut assumed anymore. So delete this. And let's move back to the operations sheet. And we forgot one thing. We actually don't only just have to delete our haircut assumption here, but we also have to turn off our debt sizing case. So let's turn this off. And now you can see that we would pick up our hard-coded line, which we haven't pulled in yet. And this is what we'll do right now with an XLOOKUP function. So make sure that you're in the first period right here. And we use an XLOOKUP to look up our end of period in case 6. Hit F4 2 times. And our lookup array is going to be in our inputs time dependent sheet. also in row 6. So select all of these dates right here, hit F4 once, and our return value is going to be, now this is important, we will select our live case principal hard-coded schedule in row 167. Hit F4 once, and if not found, we want a 0, and match mode should be exact, so another 0, close parentheses, hit enter. Let's drag this over, Control R, and there we go. We now get our hard-coded schedule from our inputs time dependent sheet. And here, by the way, this is also using an X lookup depending on our live case. So live case is case 9, and the X lookup will look at the corresponding row value for case 9, which we will then feed into our operations sheet. And now what's missing though is our actual drawdown for our frozen structure. And this is also why we don't have any repayments yet in our term loan account, because we actually haven't yet included our drawdown. And the drawdown is modeled in 568. So right here, we took our final term loan size based on the sizing assumptions within the model. And in row 568, we'll do a similar approach. So we take minus the sum of our hard-coded principal repayments in row 563, hit F4 once to fully anchor it, and then we'll multiply this with our financial close flag again. Scroll up here, select the financial close flag, hit F4 2 times, and hit enter. Drag this over, Control R, and now we can see that we have a drawdown, and the principal repayments are now picked up in line with our hard-coded schedule from our inputs time dependent sheet. So this allows great flexibility to run different sensitivities in scenarios based on a frozen debt structure. And don't worry if you haven't yet fully understood how the model works, assuming debt sizing versus frozen structures. In later lessons, we will model many different scenarios based on both sizing and frozen structures, so we will practice this model logic more in later lessons. Let's flip over to the operations sheet again. And one thing we will not do in this lesson is our cash sweep, so we can mark this row here in yellow to make sure we're not forgetting to implement our cash sweep later on. But what we will still have to implement in this lesson is our upfront fee. And the lender expects the sponsor or the SPV to pay 1.5% of upfront or arrangement fee on the final total term loan size. So let's implement this fee right now, and that is going to be equal to 1.5%, hit F4 once, times our total drawdowns, which are found in 554 column J, hit F4 once again, and we will multiply this with our financial close flag, because arrangement or upfront fees are typically payable at financial close. Right here, and hit F4 2 times. Enter. And let's drag this over, Control R. So our sponsor will get $1.2 million upfront for providing a financing of $80.8 million. So you might recall from a previous lesson that this upfront fee is also feeding into a section further up in our operations sheet, and we should have marked that in yellow. And you can see that under our CapEx section, we have modeled our upfront fee for both the senior debt as well as our LC. So let's link this now before we forget. And the upfront fee for our senior debt is now further down here. So scroll back down, and that is in row 550. So pick this one up, hit enter, drag this over, Control R, and then copy the formatting from this row, Alt HVST for pasting special format only. And that financing fee here will then feed into our total CapEx, including financing fees. down here. And if we scroll further down, you might see that feeding in this upfront fee now also causes a non-cash amortization of our deferred financing fee, which in return reduces our levered taxes again. So we need to be careful here, because right now we have probably just increased our debt capacity again, because we have more CFETs available due to lower taxes we will have to pay, since our upfront fee is amortized over a period of 15 years and is reducing our tax liability. So what we do here, let's practice this model logic. We select case 8, which is our debt sizing case. And you can see we actually get a fail right here, because as expected, our total target debt service is now slightly larger on a calculatory basis. So we hit our debt sizing macro, go to the inputs time dependent sheet, and this time we make our lives easy. We just simply pick all of these values here, Control C, and paste the values only in row 9, which is the second path of doing it, instead of just adjusting all the assumptions in our inputs time independent sheet again. Then we can select case 9, which now is based on a frozen debt structure from case 8. And what's interesting is that you will see, once we select case 9, that our total target debt service on a calculatory basis is higher than our frozen debt structure. And how is that? That is because our case 9 is the equity base case, which does not assume a merchant haircut. And if we don't assume a merchant haircut, we will end up having higher revenues. But since our debt sizing is turned off, we do not get a fail here, because once our debt sizing is turned off, we will disregard any delta here. So that ensures that this check is only turning to a fail if we're in a debt sizing case. If we assume a frozen debt structure, we obviously don't want to resize our debt and want to instead pick up our hard-coded values from our inputs time dependent sheet. And that is the reason for the formatting in 563. We have our macro paste formatting selected right here, because these are hard codes that are coming from our inputs time dependent sheet. Great, this was it modeling wise for this lesson, but let's also jump over to our financial statements really quick. We still get a balance sheet error, which is expected. But what we now see is a debt issuance cost on our balance sheet. That's the amortization of our upfront fee over time. We also see a term loan on the liability side. This is our term loan balance that decreases over time. What's still missing, however, is the equity side and our share capital, which is why we still get a balance sheet error. And in our income statement, you will also see that we have our term loan interest now reducing our net income, as well as the amortization of our debt issuance costs. And this debt interest and principal is also flowing through our cash flow statement, as you can see further up here. So under our senior debt section, we now have term loan interest, term loan principal, and what we'll model in later lessons is our DSCR LC interest, or our DSR LC interest, as well as a cash sweep. Great guys, now that we have fully implemented our term loan account, including our draw schedules, principal amortization, and interest expense, we are done with this lesson. And in the next lesson, we'll use these outputs to model our DSCR, our debt service coverage ratio, as well as our cash sweep and loan life coverage ratio, or LLCR. All right, guys, this was it for this lesson, and I will see you in the next lesson. See you there.